Hey, Mad Family and Friends, it's George Samios here. I'm here with Jerry Jones, who is a chartered accountant and a partner at Pitcher Partners Accountant, and we're here to break down the budget that came out last night. And you said, in your own words, that this is the biggest budget in your life that has the biggest impact to your clients.
I probably haven't had as many conversations within a 24-hour period as I have on this particular budget in my life or my 26 years of doing this.
This guy's all over it. That's why I wanted to get you in here. Thank you for coming in late notice. You talk a lot at events that I go to, and I wanted to, I knew this was going to be big, and that's why I wanted to get you in here. I've been an accountant for over 26 years. And look, there's three huge things that I want to break down with you today, mate. Capital gains tax, negative gearing, taxation of trust. How we got here in the first place, I don't like talking politics. And I've got a lot of respect for our Prime Minister, but he's lied to us, mate.
Yep.
And so I'm not happy about that. And what I'm trying to do today is break down exactly what's happened.
Look, he is copping a lot of grief over that right at the moment. And in his and the Treasurer's view, they're actually doing the right thing for the country. And to be honest, I don't think there's too many people out there that would not agree with the sentiment that we want more young people owning houses or more people owning houses.
He never rang me up and asked me how we get most of our loans approved, because the average age of an Aussie buying in this country is 36.
Yep.
We're going to have done it 18 years old here, right?
Yep.
And how that's happening is a lot of first-home buyers are buying for investment because they got to buy a long way away, and they want to live at home or rent with a mate, and they're buying for investment. That negative gearing is going to directly affect how much these kids can borrow.
Absolutely.
So politics aside, let's talk about the capital gains tax.
Probably the biggest change in the last 26 years is the removal of the 50% discount. So for the last 26 years, if a capital gain was made over a property, you're entitled, or any asset, sorry, it's not just properties, but business sales, shares, whatever it might be, there has generally been a capital gains tax discount of 50%.
So I make $1 million profit, I buy a property, and after 10 years' time, I make $1 million.
Yes.
Half of that's tax-free.
Yes.
500 grand. The other half is taxed at my marginal tax rate.
Correct.
So that's gone.
That is gone from effectively the 1st of July 2027. Yes, that's right. So you still can avail yourself of that 50% discount up until that point in time. But after that, there is what's called an indexation method. So it's a bit of a return to the past.
Sounds confusing.
Look, it can be confusing for people that are old enough to be around pre-99. It was quite common. The calculation itself is actually not that difficult. What you start off with is the cost base of the asset. You index that over time, and then it's only the capital gain that you're paying tax on above the indexed amount.
Okay, so and I'll explain that in a second in my eyes, because you're a chartered accountant, mate. There's a lot of big words there, and I'm gonna try and break it down.
Yep.
But does that before I do that, what about the people who bought property before capital gains tax was invented?
Yep. For the first time, they're going to be brought into the capital gains tax net. Yeah. So they will, from the 1st of July 2027, start to have capital gains tax imposed on the capital growth of their property.
I reckon that's bullshit.
Look, it's a change in system, and that's why it's so big, or one of the big impacts.
Because the problem is, right, in this country, and I started a business, and you work with so many businesses, I mean, to move the goalpost like that, what confidence does that give you in the future?
It removes a lot of confidence. Yeah. And some of the things that have been done not only removes confidence for individual investors or Australian investors, but it removes the confidence from even foreign investors that are coming in.
Well, they've attacked the foreign investors as well.
They have, yes. So they
have to buy brand new now.
Yes, yeah. And to be honest, that's a hallmark of what this budget was about. What they are trying to do is get investments into new properties.
I get it.
So when we talk about the things like the negative gearing or the capital gains tax discount, many of those changes won't apply.
It's a brand new property.
It's a brand new build. That's it.
So what they're trying to do is they want to try to get people to build or buy brand new property because they're currently running about 75,000 dwellings short per year based on their population growth.
Correct.
So they're trying to get together to see what they can do.
Yeah.
Okay, so capital gains tax, if I buy a property today or post July next year, okay, and I keep it for 10 years and I sell it and make $1 million,
Mm-hmm.
how do they work out my capital gain now?
Well, what you've got to work out, or what we've got to work out, is what the indexation is
You mean
for that period.
Would you call that inflation?
It's CPI. It's linked to a CPI figure.
Yep.
So yes, effectively inflation.
Yep. Under the new rules, on an existing property,
Yep.
if I buy a property and after 10 years I make $1 million, they're going to reverse engineer. They're going to say, okay, mate, out of that $1 million,
Yep.
inflation or CPI was
Yep.
30%.
Yep. So that means that effectively you will pay capital gains tax on 70% of the growth.
And then 70%, which is 700 grand in my
Yes.
scenario.
Yes.
What tax rate am I paying that? My marginal tax rate?
No, there is a minimum tax rate of 30% that's going to be imposed.
Sliding to?
Sliding to the
Your marginal tax rate.
rates. Yeah.
So, man, capital gains tax may have doubled.
Yeah, that's the thought process right at the moment, and some people are questioning whether they want to be involved in that, or whether they want to get out of their investments prior to the 1st of the 7th, 2027. But the impacts, though, those funds will have to be invested somewhere. So where will that be?
People will move their asset class or their investment strategy based on this now.
Yeah. Yeah, and it's talking about now resetting of basically the views of where people want to invest their funds. So, a lot of the financial people out there that deal with stocks say, like shares, that might have a positive impact on the share market. That's yet to be seen, and we don't know. And we've got to remember that the capital gains tax implications equally apply to shares into the future as they do to property.
Even business?
Even business. Yes, that's right. That's right. Depending on the way that the structure is set up within business.
Is it a standard company or family trust?
If it's a standard company and the shares owned in that company are sold, yes, they are impacted.
So, Mad Family and Friends, this government hasn't only changed this for property, they've changed it for shares and for business. So, Bob's Mowing, in a couple of years' time, sells for $1 million. Before, they would have a 50% tax-free component of that sale, and the rest would be taxed at their marginal tax rate. Now, they've got this Houdini way of working it out, but basically it's double what it was.
Yep. Whether it's double or not, time will tell, but it will have a significant impact.
Well, mate, they can't tackle inflation.
Yeah. Yep, correct.
So that's on existing and so on. What about brand new property?
Brand new properties are carved out of those the rules that we're currently talking about. So if it's brand new property, you have the option to continue on with the 50% capital gains tax discount. And you said currently, based on what we understand, unless they change the rules, the devil is in the details. So we're yet to see the actual legislation come out. So that might change things.
You're right,
slightly.
because just on that point, right? The reason this could all happen is Labor, we've got too many seats and they don't really need, they can't be lobbied and sort of being dictators right now with the decisions.
For the most part, that's what we understand, that they're going to be able to bulldoze a lot of this stuff through.
So probably we'll go through and we'll know the finer details in 2 weeks.
Correct. All the finer details will come out. We'll then be able to start to analyse it a lot better than what we are at the moment. So what we're basing a lot of these conversations on are pure budget announcements from last night. Yep, that's right. And what the Treasurer has released prior to last night.
So if I buy a brand new unit, all right, in 3 years' time, and let's just say this is set in concrete and doesn't change, and I sell it in 10 years' time for $1 million, that unit has the same rules as what was yesterday, which was 50% tax-free and the other 50% is marginal tax rate because it's brand new.
Correct. Yes, if it's a brand new property. Now, again, the devil might be in the detail. We're not quite sure what they mean by brand new or new residential property. We presume it's similar to what they talk about with GST, and we presume it takes it.
So they're trying to tackle more housing.
Trying to, yes. But a lot of the other, some of those changes, like the impacts of CGT on share portfolios, for instance, how is that impacting the housing crisis or the taxation of trusts? We're not quite sure how that's impacting on the housing crisis. Now, my view is that they've wrapped all of this up into, and what they have referred to as intergenerational equity. So they're trying to make the tax system fairer. And so they're saying the baby boomers along the way have got all of these tax breaks, and they have built their wealth on the basis of these tax breaks and structures that they were allowed to continue. Now they're taking those away. So it's going to impact more of the baby boomer or older generation that has more wealth than the younger generation generally. That's the idea. Whether I agree with that or not, I don't know. And, I think that probably the other big thing that was said last night, which I don't know where they get their details from. They do have their modelling in the background, but they have acknowledged that rental prices will go up because of this.
There's no question rent will go up.
The number that they said is that it will go up
$2 a week.
$2 a week. Now, I don't believe that. I'm having conversations with clients in the background and prior to this where they have already said that if they take away the negative gearing, that's going to be an actual cost impost on them because they don't get that reduction in their tax. So where do they get that from? It's through increased rent. There is those concepts and those thoughts already occurring out there. And so then I question, well, it makes it harder for those people that are renting to then save their deposit to actually get into the market. So, there is a little bit of tinkering or there may be some tinkering along the way. I'm just not quite sure how.
The devil's in the detail. Let's wait and see what happens in 2 weeks regarding CGT. Now let's talk about negative gearing.
Yep.
First-home buyers, the way they're getting in the property market now, mate, more often than not, they're not buying to move into.
No.
They can't afford it already, mate.
Yeah.
They're buying for investment. And we're using negative gearing. So they say hypothetically renting with a mate or by themselves or with their partner in a suburb that they like.
Yep.
And they're having to buy an investment property further out as a stepping stone.
Yes.
To try to get back where they wanted one day. And the negative gearing, I have to tell you, mate, without having negative gearing in getting a mortgage.
Yep.
Obviously because those tax benefits of it.
Yep.
I don't know how they're going to even afford to buy their first house anymore.
That has absolutely been explored out there with some of the commentators that they are saying that will have an impact on lendability and so the ability to get in. I'm not quite sure how that's going to play out, but it will have an impact.
So negative gearing gone.
Yep.
Is it still for brand new properties, or is it for what's the detail there?
Again, it is for brand new properties, and it is also for properties that are owned as at the budget night last night. So that's 7:30 on the 12th of May, 2025. If you owned a property, 2000.
What about if they signed a client? A lot of clients who have properties under contract right now haven't settled yet, but they're under contract.
Yep. Once again, the devil will be in the detail, but most capital gains tax or the regime looks at the contract signing date. So if a contract has been signed, theoretically, under the existing rules, it comes under the net.
Another thing that I'm going to state the obvious here, it looks like they're fully targeting existing properties. All right,
Yes.
so they want people to buy brand new. They want to promote satellite cities.
Yeah.
Move out in the middle of nowhere, please, and live on a 250 square meter property, and that's how they're going to try and cope with our population increase. I think, with my normal sensible glasses on, construction price is going to go through the roof.
Yeah.
I mean, if that's what everyone's going to want to buy now, you're pretty much forcing the market to go buy a brand new unit or house.
Yep.
Construction prices are already ridiculous.
Yep.
They're only going to go higher and higher now, especially with an Olympics in 6 years' time, who's going to soak up all our tradies.
Yep.
Good luck building anything in Brisbane.
That's exactly what we're hearing. So, it's a great outcome for builders. And, ultimately, that supply demand should increase the cost of that housing prices. And you're exactly right. There are already what we understand is a trade shortfall. There's difficulty in getting trades already. This is going to add to that.
It'll never be cheaper than today. If you're watching this and you want to do a renovation, I'd get it done now. With all this stuff changing, and if you're a kid watching this, maybe you want to get a trade, probably not a bad idea.
No, that's right.
So negative gearing, though, just to wrap that up, is not to be affected for brand new dwellings, houses or units or townhouses.
Correct.
It's the same as before.
Correct.
But it is completely and 100% will affect you if you're buying existing property.
From the 1st of July 2027. That's right. So If you've got a property as of last night, so the 7:30 on the 12th of May 2026 that was negatively geared, you can continue to negatively gear that until you sell it. If you bought a property after today, or
You still got a year of negative gearing?
You've got a year of negative gearing, that's right, and then it stops.
Big whoop.
Yep, that's right. Now, what we don't know
quite
yet
funny.
is what's going to happen with those negative gearing losses. So we understand that they will accumulate and offset against future gains. If you've got 5 years worth of losses that accumulate under negative gearing of, let's say, $50,000.
A year or
no, in total. Let's say you've
yep.
got 5 years, and then all of a sudden that property turns to being positively geared. You can start to offset that income from the positively geared property against the losses.
But the normal negative gearing, you can do that every year.
Well, you can offset it not only against other properties, but also against your salary and wage income.
Yes.
So you can offset it against any income that you've got.
Yeah.
Now you won't be able to do that. That's the whole concept of the removal.
Big changes, and I think a lot of confidence lost in the current government.
Yeah.
I've got a question for the Gen Zs, mate. What they've done is they've said, hey, man, you're a boomer. You're a Y-Gen, George. I'm getting negative gearing. You'll probably get negative gearing. But as of the July 1st next year, the newest generation, they don't get that, mate.
Yes.
Bullshit, eh?
Yes. And it's going to impact on that generation that's coming through.
It is.
Absolutely.
And they want to try and help them.
Yep.
But the truth of the matter is I've already bought properties.
Yep.
And I'm not affected because all my negative gearing on my properties, which is secondhand, they're all grandfathered.
Yes, correct.
But if you want to buy a brand new one, you're a 20-year-old and you want to get in the market, you don't get negative gearing on it.
You don't.
Yeah.
Absolutely.
That's a disadvantage.
Yes. Yep. Yeah. No, but it's all around the premise, and this is the government's view, that it's helping those get into the market for their first home. But it's going to have a big impact on those. And look, there is a lot of mum and dad investors out there. We know just through our client base, we see a lot of mum and dad investors that I don't necessarily, they're well off, they're okay. But when I say they're well off, they don't have issues. They can pay their mortgages and all of that sort of stuff. But I don't consider them overly wealthy. They're getting by. But this is going to attack those people that have taken a risk and actually done something.
I agree, mate. You're actually attacking the everyday Aussie who I'm passionate about helping, whereas you should be chasing Google and all these massive companies for taxes, not the everyday Aussie, mate.
Yeah, that's right. And look, these changes, all of these changes that you're talking about, are no doubt going to increase the taxes on a lot of Australians. I don't want to say most, but a lot of Australians.
Not good, Labor. All right, taxation of trusts.
Yes.
Let's talk.
Yes. Taxation of trusts. So this is probably the one that we within our office have had most discussions on today. However, it's probably the one with the least detail in the budget and the announcements. So this is the one that we are genuinely worried about how this will impact. I act for a lot of small to medium-sized business owners, a lot of family business owners across Australia. And most of those business owners use trusts. Now, it's not for the scaremongering that everyone's talking about. It's not for complete tax avoidance. A lot of trusts, their primary purpose is for asset protection. They're going to turn this around and tax trusts at a minimum rate of 30%. Now, the issue...
You say minimum, man. Like, how much can you go further?
Well, when the distributions go out to individuals, so trusts generally don't pay tax.
So a trust makes $500,000.
Yep, that's right.
And
they'll pay 30% tax.
So they have to pay 30% first.
According to the current announcements, yes, they're going to have to pay that 30%.
And then let's say you want to distribute the profit to Jeremy.
Yes.
And let's say it's above your marginal tax rate of $190K.
Yep.
So they've got the catch-up tax there as well.
Correct.
So it's like a company now.
But it sort of, yes. So you get a non-refundable, as an individual, I get a non-refundable tax offset for the trust's tax that has been paid on my distribution.
Yep.
So for someone that is over $45,000, it's probably not going to be a huge impact.
Yep.
But what a lot of family businesses have done in the past is they will distribute across the family group. So, for instance, to spouses that may not be working or may have a lower income tax rate, or children along the way over the age of 18. There is no doubt that those beneficiaries, there is going to be a higher tax profile because there is 30% minimum that's going to be taxed.
Whereas if you distribute to your 20-year-old son, who, under 20 grand, there'll be
Yep.
no tax.
Correct.
Where now that'll be 30% tax.
Correct. Yep. So there's an immediate impact. So look, that's going to be an impact, but probably the bigger one that we're seeing or we have noticed is the use of a corporate beneficiary.
Yep.
Okay, so the impact on a corporate beneficiary is that they don't get the credit that an individual does for the trust's tax that is being paid. So if you think about that, okay, $100 gets distributed to that trust. It pays tax at 30%.
Yes.
It's left with $70. If that gets distributed to a corporate beneficiary,
He's got to pay it again.
that tax will be paid on the
That's
$70.
25.
No, it's most often with the corporate beneficiary, it's around 30%. So it's another 30%. And then it has to come out from the corporate beneficiary.
And then if it goes back to Jeremy, he gets taxed at your tax rate.
Correct.
But is there any like franked?
There is the franking components when it comes out, but a lot of corporate beneficiaries are owned by a separate trust. So that means when it comes out to that trust, it can be taxed again. So once again, we're really concerned around that. But the bit or the concern that we don't know or the concerns that we're raising.
What I'm getting from this one is, as you can see in accounting, mate, it's like a different language.
Yeah.
And I only know this stuff because I have these structures.
Yep.
But if you're watching this and you're Mr. Minute, or you got a small business, or you even own properties in corporate structures like a trust or a company, talk to your accountant how this budget affects you. Because unfortunately, a lot of people are going to be affected by this decision, which I heard they only thought about this a couple of weeks ago.
Yes.
Which is just offensive.
Yeah. Look, they have been talking about it for the last 30 years or 26 years. So as long as I've been in practice, they have considered or talked about the concepts of taxing trusts, but it's never come to fruition. Now they have brought it out, as you say, it's only relatively recently that they have come up with the concept. Our view is that they have pushed the taxation of trusts out to 2028 because it gives them, number one, people a bit of time to restructure. But number two, I think it gives them the time to understand the sentiment. Yeah.
I'm going to tell you two good things that I saw last night that I'm going to talk to you about in a second. But on that, before I do that, on the point of there to restructure, I mean, if people are in now not a good enough structure, mate, they have to pay stamp duty and capital gains tax to restructure. It's an unnecessary cost on Aussies.
Yeah, absolutely. Look, we haven't heard from any of the state governments around any stamp duty relief or restructure relief around stamp duty, but there was an announcement in the budget last night that they will provide some restructure relief. Now, what that means, we don't know.
I'm sure they will, and there's a lot of trust right now, isn't there?
Yeah, that's exactly right. And look, we as a profession are already thinking about the concepts of what can we do with our clients, because as you say, look, we've got a wide variety of clients along the way. So we've got some really small businesses, we've got some really big businesses, but the commonality across all of them are that they're family owned. Some of those really small businesses, even when they are structured as a small business, they're going to be structured with some sort of a trust associated with them, whether that's a shareholder of a company or they're running their business through a trust. That's going to have an impact. So what you said was entirely correct. Go out and have a chat to your accountant. Probably not now, because we still don't know the details.
In 2 weeks'
Leave it for, and look, there is time for this restructure, and so it's not going to be all done at once. And as more ideas come out, those will get better. Those ideas will get better.
Look, there's two things that I want to say that are still beautiful about this country, and they didn't attack, which I think is worth mentioning right now. There is still no capital gains tax at all on your main residence.
Correct.
Right? So your principal place of residence, your own occupied property, and that is a great way to get ahead in this country, is to buy your first house, you claim it as your principal place of residence, and if it makes $1 million, mate, tax-free. That's a good one.
Yep.
That's still there, and if they were to touch that, not good, mate.
No, political.
Don't touch that.
Yeah.
And number two is they didn't touch super.
Yep. Albeit though, they have they've had a red hot crack over superannuation for a good couple of years now. And so a superannuation, look, as an accountant, we still love the concept of superannuation.
Me too.
And it's still an environment where, depending on the amount that's in superannuation, when you're in pension mode, it's tax-free. Even when you're not in pension mode, when we're accumulating assets, the growth of those assets is only getting taxed at 15%. That's far better than the top marginal rate of 47%.
There's a benefit of super is purely tax reasons. So if they go to tax it more, then what's the point? No one will do it.
Yeah, they have tinkered around with it, but it's more at those higher levels. So if you've got more than $3 million or more than $10 million in superannuation, there is absolutely some movement they've got.
Look, a lot of our clients, they buy investment properties through super, whether it be a house or a commercial property. That still can happen.
Absolutely. And the good thing about that, George, is that within superannuation, they haven't touched the capital gains tax discount within superannuation.
Good to clear up.
So you are still entitled to, it's not a 50% discount, it's a 33% discount.
I've worked the numbers a fair few times, and it works out to be about 10% capital gains
That's
tax.
exactly right. Yep.
But that's if I'm not retired.
Yes.
If I'm actually over 60 and I'm retired, the capital gains tax is
zero.
Yeah.
Yep.
You can't get much better than zero.
No. Depending on the circumstances, mind you.
If it's worth $100 million, it's different.
Correct. But for most people, the tax impact of the sale of any asset, whilst in pension mode, is a 0% tax rate.
Mate, that was I feel a lot more clear now. Thank you for coming in.
No problems.
I think everyone who's watching this, whether you're a first-time buyer, mum and investor, you're a business owner, I feel more clear. I understand exactly what's going on. I'm not happy about it, but at least I know and I'm educated now on the fact. I appreciate your time, brother.
Not a problem. Thanks for having me.
You take care, mate. Good on you.
Thanks.
Thank you very much.